Well, hello and welcome back to Principles of Accounting 2. I am still your host, Dr. B. Happy to have you back with us as we continue the spring 2023 semester. We made it through the halfway mark. I haven't seen any of you for the past few weeks because of a couple of different things. Last week you had your spring break. The week before that was the midterm week, and the week before that was the midterm for this course. So it's been a while. I apologize for the amount of time in between, but hopefully you had the opportunity to get well acquainted with your other courses and get some much needed time away. So I'm glad that you are back and that we are back. I want to quickly call your attention to where we are in the classroom, and then we'll start discussing this concept called budgeting. We are currently in Module 3. We finished up Module 2 with your midterm exam, and then when you had the midterm, the spring break, and here we are in Module 3. Module 3, starting in week 9, we have Chapter 22, which is a concept called budgeting, which we're going to cover in detail. And then next week we'll have Chapter 23, and then we'll do 24, and then 25, and then in Module 4 we'll do 26. We'll study for the final exam, and you'll take your final exam. And we're not too far off. It doesn't seem like a whole lot of time. We got about 5 weeks left together, so we will make the absolute best of it. So for those of you following along at home, let's do Module 3, Week 9, Chapter 22, and we will begin our discussion on budgeting. Budgeting, hopefully, is not a new concept for you. Hopefully, you all have a budget. Budgeting is very, very important. It's important that we have a plan for the business. It's important that we have a plan to run the household, that we have a plan for school. We have a budget. The budget gives us permission to spend in certain areas. That's the concept of a budget. We use a budget in business to plan for the future of the business. That's the concept behind budgeting. I'm going to give you a couple of examples that I've had using budgeting in the hotel business. I'll also give you a couple of examples I have from personal experience, etc. So let's talk about budgeting. What is it? Why do we do it? Talk about the various expenses involved. We're, of course, going to look at this from a perspective of a manufacturing company because we're still talking about materials, direct labor, and factory overhead from the perspective of manufacturing. In addition to that, we'll try to help you to understand the conceptual framework behind budgeting. So what are the benefits of creating a budget? It gives us the ability to plan for the future. We can coordinate different departments within the business together to meet the company's objectives and goals. We can use a budget to talk about the performance of the business and match it to those goals. Helps us to coordinate, motivate, plan, and control for the future. These are all the benefits of developing a budget for the business. Budgeting is very behavioral. I've always said that finance and accounting are 80% behavior and 20% book knowledge. What I mean by that is that humans are motivated with money. We do a lot of things for money, don't we? We behave based off of money. Budgeting can provide both a positive and negative human behavior. From a positive perspective, I can attract employees. I can consult with employees on the budget. I can help my employees to help the company establish goals. And it also provides some motivation for employees to try to meet the goals of the business based off of the budget. Those are all great things, positive behavior. But of course, there's also the negative side of human behavior when it comes to budgeting. Sometimes an employee might understate their sales and overstate their expenses to provide for a cushion. We call this padding the budget. When you pad a budget, what you're doing is you're setting unrealistic goals for expenses and less than mediocre sales goals. All that padding the budget, understating sales and overstating expenses allows for a cushion. That's a bad thing. You don't want to do that. You want to try, when you establish a budget, to be as close as possible to what the actual performance is going to be. Just like your house, right? I budgeted $150 for the electric bill this past month. That was the budget. That's what I said. Hey, you know what? I think my electric bill is going to be $150. That's numbers based off of what happened last year for the same month. I said, well, you know what? February 2023, my electric bill is going to be $150. So I thought. That actually came in at $190. The point of the budget is to be as close as possible. It's better than me saying, "Oh, my electric bill is going to be $250," when I know last year it was $150. Why would you budget an extra $100 for the month? Don't do that. You want to be as close as possible for both expenses and for sales. If I expect to sell $25,000 this month, I want to budget for $25,000 worth of sales, not 20, knowing that I'm going to come in more than that. The reason for that is you're going to have direct materials, direct labor, and factory overhead for those additional sales that you didn't account for in your budget. So you want to be as close as possible. Humans feel pressured to meet results. This could lead to unethical or fraudulent behavior. Those are bad things, okay? Don't feel the pressures to steal or do things that are unethical. Sorry. Employees might decide to make unnecessary purchases to meet the budget, so that way next year's budget is the same or is not reduced. This is a common problem in government agencies. They always say we need to spend as much as we can this year so that way we get the same amount next year. Don't do that. You're wasting taxpayer dollars by doing that. Again, an unnecessary thing that's run by negative human behavior. Budgeting, very behavioral. I always operate on the premise of what we call continuous budgeting. I have a 12-month budget for the next 12 months. Always. What I mean by that is I started my budgeting process in January of last year. I budgeted through January of this year. When January of last year ended, in the February of this year. February of last year ended, I moved into March of this year. March of last year ended. Now I'm into April of this year. I always have 12 months of a budget in front of me, regardless of where I am in the year. Call that a rolling budget. Always have 12 months out. This is a very good practice. You want to make sure that you have 12 months of budget in front of you. It helps you to plan for the future. In a large business, even in a small business with many departments, we have a large budgeting process. I'm going to give you some stories from my history. Those of you who know me know I used to work in the hotel business. Okay, I was a financial controller for a long time. In that experience, I was responsible for the hotel's budget. A hotel, as you know, has multiple departments. You have rooms division. You have front of house, back of house. You have, within the rooms division, housekeeping, engineering, also known as maintenance. You have sales department for the rooms, front desk. All of those typically belong to the rooms division. Then you have the operations. Operations might include things like food and beverage, banquets, food and beverage, restaurant, etc. Right? The list goes on and on. Large hotel companies have a lot of different departments. So I was responsible for the budgeting process. With that responsibility, every year we had budget meetings, usually 3 or 4 of them. And the way it worked was I went to every single department head, whoever was in charge of that department, and I said, hey, manager, director, whatever, I said, hey, I need you to provide me with a budget for your department for the year. Here's the amount of money that we're going to allocate to you, your department, and I want you to budget it out, line item by line item. And so I would do that to every single manager of every department. I would collect all of those individual department budgets and put them into the system and create what's called the master budget for the whole hotel. It was a fun experience, an interesting experience, and sometimes a very frictional experience. So it was interesting, to say the least. Every business works that way. Yeah, typically. There's a lot of different budgets that make up what we call a master budget. So in manufacturing, it's no different. We have a lot of different departments in manufacturing. Sales, production, selling administrative, capital. Think of these as different departments. I need to create budgets for every single one of these areas. Every budget starts with sales. Every budget starts with sales. I need to know how much I expect to sell in order to create all of the other budgets. Things based on sales. For a personal budget, it's based off of income. Budget's based off of how much I bring home. The amount I bring home tells me how much I can spend and on what things. It works the same way. So sales drives the process. The quantity of the things I'm selling times the sales price tells me the dollar amount of sales I expect to make within the year. That amount, the quantity and the cost, drives the production budget. Within the production budget, I budget for the amount of direct materials I need to purchase in order to make all of the units I expect to sell. The direct labor to build all those units that I expect to sell. The amount of factory overhead I expect to use in order to create the number of units I expect to sell. See, production budget that includes direct materials, direct labor, and factory overhead help to drive the cash budget. The cash budget is the amount of cash I'm going to need to purchase the direct materials, pay the employees, and to pay the bills for the factory overhead. Sales budget also helps to drive the capital expenditures budget and the selling and administrative expenses budget. Selling administrative expenses includes sales commissions, the office staff, office materials, etc. Capital expenditures includes the planning for the purchase of new property, plant, and equipment to keep the business running or growing. And all of that drives the cash budget, how much cash I'm going to need to do those things with. You see? All of these together equal the master budget. I'm going to talk a little bit more in detail on all of these things. Everything starts with sales. This helps to drive the process. So the sales budget, first thing we do, tells me the number of units I expect to sell and at what price. It's times price gives me this total sales dollars. Okay, this is really important information. Information tells me what I can do in order to generate those sales. Yeah. How many units I need to make. Here's an example of a sales budget just for 3 months, so for the quarter. Here we have a company that makes hockey sticks. They sell them for $60 a piece. Expect to sell 1,000 units in October, 800 units in November, 1,400 units in December. So I expect to sell a total of 3,200 units at $60 a piece. That'll help me to generate $192,000 of expected sales for the 3 months. Now that I know that I'm going to sell 3,200 units, $60 a piece, I need to make sure that I have enough my beginning inventory to sell what I have in inventory currently. Number of hockey sticks I currently have, beginning inventory. I need to figure out how many I need to make. Okay, so that helps me to prepare the production budget. How many units I need to make based off of the projected sales. So units to produce is based off of the ending inventory units plus the budgeted sales units minus the beginning finished goods inventory. I'm beginning the year with some inventory, the finished goods. Need to get the ending inventory plus the beginning sale, the sales units. So 3,200 I expect to sell, minus whatever I started with. I mean, how many I need to make. Required units for the period. How many I need to produce. So looking at our example, here's how it works. We take the number of units times the percentage of inventory for future sales equals the budgeted ending inventory. Budgeting and ending inventory carries over to the beginning inventory of the next month. We add in the budgeted sales, number of units I expect to sell for that month, equals the required units of available production minus the beginning inventory from the previous month equals the number of units I need to make. I need to make 710 units in the month of October. Make sure I have enough to sell in November. In November, I need to make 1,340 units to make sure I have enough to sell in December. So that's the production budget. So how do we budget for direct materials, direct labor, and factory overhead? Because remember, direct materials, direct labor, and factory overhead equal the production budget. So we look at each component separately. So for direct materials, we're looking at all the materials we need to produce the number of units required for production based off of the production budget. We take the budgeted production units, multiply that by the required amount of materials per unit. So half a pound of wood per hockey stick in this example equals the materials I need for production. We add in the budgeting ending inventory in terms of pounds of wood equals the total materials required minus the beginning amount of wood I started the month with equals the amount of wood I need to purchase in order to manufacture the 710 hockey sticks for that month. The current price of wood is $20 per pound. Means 20 times the 512 will give me $10,240 for the month of October. I need to spend in direct materials. I need to purchase that amount in direct materials for October. See? And I do that for every month thereafter. For labor, it's a similar process. We know how many hockey sticks we need to make for the month. We know how much labor is required to make each hockey stick. It's 25 minutes out of the hour. So 0.25 over 60. So 710 units I need to make times 25 minutes, 0.25, equals 177.5 hours for the month. Currently pay my employees $12 per hour times the number of hours needed gives me a cost of direct labor of $2,130 for the month of October. I do that for every month, that same process. Number of units expected to produce times the direct labor per unit equals the total direct labor hours needed. Multiply that by the hourly rate gives me the total cost of direct labor for the month. Do that for every month. For factory overhead, this is usually done by the predetermined factory overhead rate that we talked about a couple weeks ago. In this example, it's $2.50 per unit. So we take the number of units times the variable factory overhead rate equals the budgeted variable overhead plus the fixed overhead rate gives me the budgeted total overhead for the month. Do that for every single month. So now that I have my direct materials, direct labor, and factory overhead costs all figured out based off of the number of units I need to produce, I can figure out the product cost per unit. Do that by taking the amount of, for direct materials, it's the amount of materials per unit times the price per pound of materials. For example, it's $10 for direct materials. For labor, it's the time it takes to create one unit, in this example, 25 minutes, times $12 per hour, gives me $3 for direct labor per unit. The variable overhead is $2.50, that's predetermined rate. Fixed overhead is $1.50. How we got that? We take total fixed overhead divided by the number of units we expect to produce. To find our total product cost per unit, we take direct materials plus direct labor plus variable plus fixed unit to get a total cost in this example of $17. So now I figured out my sales budget, my production budget based off of direct materials, direct labor, and factory overhead budgets. I figured out the total cost per unit. Now I can find the cost of goods sold budget. Cost of goods sold budget, very straightforward to prepare. We take the budgeted sales units, number of units I expect to sell, times the cost per unit. Gives me the budgeted cost of goods sold. For selling and administrative expenses, as we had said earlier, it's based off of things like commissions, salaries to managers, office staff, etc. For selling expenses, it's commissions and sales manager salaries. For commissions, if it's a percentage, we take the percentage and we multiply that by the amount that we expect to sell in terms of dollars. And then for salaries, we just add the salaries. As an example of that, I expect to sell $60,000 worth of hockey sticks in the month of October. 10% sales commission, that's commissions of $6,000 for the month. Plus the $2,000 salary for the manager is $8,000 total selling expenses for the month of October. I follow that same process for every single month. The general administrative expenses, these are the office salaries, etc., shipping expenses, etc. These come from the planned expenses on the income statement, which are line item expenses. Oftentimes we average this out by looking at things like salaries and just divide the number of salaries by number of months. Very, very straightforward. Selling for administrative expenses. Total salaries divided by number of months. For the capital expenditures budget, as I had mentioned, this helps us for future growth of the company by purchasing property, plant, and equipment, or sometimes disposing of property, plant, and equipment. This is usually very specific. What a lot of businesses do is we set aside a certain amount of cash every month, kind of like in a savings account, if you will, to plan for the future purchase of things like property, plant, and equipment. So we talked about sales budget. We talked about the production budget, which includes direct materials budget, direct labor budget, factory overhead budget. And then we talked about selling budget. We talked about the administrative expense budget. We talked about the capital budget. Now let's prepare the cash budget. All of those things trickle down to what we call the cash budget. And this is the use of cash for doing things like purchasing materials, paying your employees, paying the factory overhead stuff, planning for capital expenditures, paying your administrative staff, all of those things, right? Use the cash budget to help us predict the cash that'll come into the business from sales and out of the business for all of those expenses that I just said. So we use this general formula to help us to guide our cash budget. We take the beginning cash balance plus the cash that we receive from our customers through sales minus the budgeted cash payments we expect to pay for the bills. This equals the preliminary cash balance. If it's good, meaning it's adequate, we can also use any additional cash to do things like repay loans or buy securities. If we don't think we're going to have enough cash on hand at the end of the accounting period based off of the budget, we would want to do some short-term borrowing to make sure that we cover any type of gap that might exist. For example, 40% of our customers pay us in cash up front. The remaining 60% of our customers pay us on account or accounts receivable. And so I can plan the amount of cash that I would receive on a monthly basis. We take our total sales, and if I know that 40% of my customers are going to pay in cash, I can put that there. Minus, so sales minus last month's accounts receivable equals receipt from cash minus your cash sales plus the collection from previous month receivables equals total cash receipts. And that's how we budget the amount of cash that we would expect to receive on a monthly basis. We could also budget the amount of cash that we would expect to pay every single month, and that's going to be based off of your direct materials budget, direct labor budget, factory overhead budget. And here's an example of that. Materials purchases, etc. So using the basic formula, beginning cash balance plus the amount of cash we expect to receive from our customers minus the amount of cash we expect to pay for our operating expenses equals our preliminary cash budget. If it's good, we can repay loans and buy securities. If it's not good, we need to do some short-term borrowing. And this is an example of the cash budget for our company. And this is a nice graphical representation of all of those things together in one spreadsheet. So beginning balance plus cash we expect to have from our customers minus cash payments for each month equals a preliminary cash balance. Then any type of loan activity, if we need to borrow or pay back, etc. Again, having these types of budgets are really important for both the business and for personal life as well. That's why budgeting is so important. It's just going through all the steps that we just talked about. keep forgetting how many pop-ups there are in this. Again, it's going through the process. Based off of all of the budgets that we've done, the sales budget, production budget, which includes budgets for direct materials, direct labor, factory overhead. We talked about the capital expenditures budget, sales budget. I'm sorry, the sales expense budget, and the administrative expense budget, and the cash budget. Now that we've done the cash budget, we can actually budget for our income statement. The income statement, as you know, shows the sales and all of the expenses for the company. The expected sales will be based off of the sales budget, and all of the expenses are based off of the cash budget. And all of this information is important because it'll also help the business to plan for the future payment of things like taxes. We can also prepare a budgeted balance sheet based off of the budget from the cash, because as you know, cash is an asset on the balance sheet. Property, plant, and equipment from our budgeted capital expenditures. We can also budget for the direct materials, which are under current assets as a form of inventory. So yeah, those are the types of things that we can formulate on a budgeted balance sheet. This is what we see here. For a service company that doesn't have things like direct materials or factory overhead, you can also create a budget for those companies. And again, as I mentioned, everything is based off of the sales, the income, the revenue. We can budget for things like direct labor, the capital expenditures, property, plant, and equipment, selling administrative expenses, and ultimately the cash budget. Works the same way, just without a couple of those additional components. When it comes to planning for your expenses, which are of course on your the operating expenses of the company, we can do that based off of what we call activities. Activities, through activity-based costing, helps us to identify the budget based off of those respective activities like auditing, tax reporting, financial reporting, cost accounting, other operations. Those operations help us to formulate the budget. It works the same way as traditional budgeting. It's just a matter of classifying the individual line items into activities instead of traditional line items. Just another way of looking at it. That's all. And looking at the master budget for a merchandise company, as you know, is like a retailer. Example would be Macy's, sells inventory. Difference here is it's still based off of sales, the amount of inventory they expect to sell. It drives the purchases. That's the inventory that the merchandiser purchases from their suppliers. That helps to drive the cash budget, selling administrative expenses, and capital expenditures. Very, very similar. We have an example of a merchandise company that sells the hockey sticks for us. To find the inventory that they need to purchase, we take the ending inventory budgeted plus the sales we expect to make minus the beginning inventory budgeted. That will tell us how many hockey sticks we need to purchase. order to sell. And we can prepare a budget for a merchandise company using the same methods that we used for the service company and to some degree, to the manufacturing. We take the sales budgeted times the inventory of future sales percentage equals the ending inventory plus budgeted sales, gives us required units we need minus the beginning inventory equals the number of units we need to purchase. Take the number of units we need to purchase times the purchase cost, gives us the cost of merchandise for the month. It's a very, very similar process. Just like anything else in accounting, the best way to learn it is to practice it and to do it over and over and over again. And I promise you'll get it. It's just a matter of practicing it. That leads me back to the classroom. One thing I would like you to do before you try your homework is to try to run through that Chapter 22 exercise. I think you'll find some value in it because working through a budgeting process with a hands-on learning experience really does help to emphasize exactly what it is that you're learning. So please feel free to work through these, download the Excel documents and just work through them. They're not graded or anything, but I encourage you to try it out because it really is a really effective way of learning, is by working through a couple of examples yourself. Yeah. And then for Thursday, try to complete your homework assignment by Thursday during the class time. I think that having that additional time was really helpful for you because it gives you that opportunity to really try things out. And of course, when things don't work out as you planned, you can always email me, call me, set up office hours. In looking at the classroom, if you scroll up, you can always set up office hours with me here using this link. You can always email me. You know that I'm quick to respond to you. Or you can just give me a call. Whatever you need. I'm here for you 100% of the time. Are there any comments, questions, concerns about the chapter, about the concept of budgeting, anything at all? Anything at all? No, it's kind of boring. We're talking about budgeting. Accounting can be a little boring sometimes. It's one of the boring chapters. Yeah, I agree. But is there anything that I didn't cover that you hope that I would? Did I do okay?
No questions, Professor.
Awesome. Thank you, Maria.
Thank you.
I appreciate you. Okay, wonderful. If you need anything, email me, call me, set up office hours. Whatever you need for you, I'm here for you 100% of the time. Please make sure that you complete the homework assignment by Thursday. Otherwise, it is due on Sunday, but I'd like you to use that class time on Thursday to get that done. And as always, stay safe, wash your hands, do the right things, and I'll see you all again next time. Thank you so much for your time today. I appreciate all of you. Have a wonderful night.
Thank you, Professor. Have a good night.
Thank you. You too. Take care. Bye-bye. Thank you. Y'all are the best. Take care. Bye-bye.